Hey everybody, Preston Brent here with our Trader User Group, a weekly roundup. This is for the trading week ending July 1st, 2016. First of all, I want to send out a happy Independence Day, July the 4th weekend to everybody in the U.S. markets. It's going to be a long holiday weekend, and I'm sure for many of you people, it'll probably be well deserved. So the markets in the U.S. will be closed on Monday. It'll make for a very light trading day in other markets internationally. Before I jump in, I mean, it's really amazing. We're halfway through the year now, 2016. And man, what a year or a half a year it's been. I mean, it seems like ages ago that we had the big existential threat to the U.S. or to the global financial markets, probably better put, with the Chinese devaluation of the yuan that happened in August of 21st last year. Really amazing. We had the that big, huge implosion that happened right here, and the markets just fell off the table. In fact, we had the biggest move ever in volatility in the shortest period of time. And then you can see since that point in time to where we are right now, we are almost exactly where we started, but not without a ton of fireworks. I mean, we've been up and down, just amazing fireworks, just really crazy. So over here, we had the Chinese threat. And then fast forward here, we had over in Europe, we had the BREXIT vote, which of course surprised everybody. And then sandwiched in the middle here was right in this area right here, we had the U.S. Feds come out in this area here and raise interest rates by 25 basis points, which set the market back to the downside again. And at that point in time, there was a forecast, according to the Feds, that we would have 4 rate hikes for 2016. Count them, 4. So that was enough really to start to move the bond market, but the bond market didn't move that much, surprisingly. And then we fast forward to current time right now, right in this area here, where we see the bond market is at all-time highs and the yield is at all-time lows, not only across the 30-year, but the 10-year as well. It is really amazing what a half a year makes, with it really starting in late summer of last year. And with this Brexit vote, we saw about $3 trillion come out of the global markets literally in 2 days. It was one of the largest exodus and loss of money in such a short period of time. It was really amazing. In fact, members in our group, we were up trading Thursday night, well into early Friday morning hours, New York City time, and we were having a lot of fun. I put out an asset document, or an asset class document, that showed which assets you wanted to be long and which assets you wanted to be short, whether the British voted to stay or leave. And of course, the markets were surprised with a leave vote. And then the markets just took off. And then this past week took off to the downside. But then this past week, in just 4 trading days, on Tuesday, after the world equity markets kind of got a little bit more solid footing, we saw a huge move back up. I think the markets were down 6%, and now they're up a little over 4 or 5%, almost making up the entire loss from Tuesday through Friday. The Dow was up for the week about 3%. I think the S&P is up around 3, and the NASDAQ was up a little 3.3 or something like that. So we also got the Bank of England doing what all the other countries are doing too, which is saying, hey, we're going to do more stimulus. So the Bank of England is just going to add to it, which, you know, caused the pound to truly get pounded. So now we're in a situation as we start up the second half of the year and everybody's going, man, are we going to have this kind of year going forward? And this just goes to show everybody that is a stock picker, everybody that says the markets are going higher or they're going lower, well, then everybody was right because the markets did go higher and the markets did go lower in a very, very wide range. And if you were on the wrong side of that, then you were definitely punished. The biggest winners so far this year also are those stocks and sectors that act and look and feel more like the bond market, and that would be like utilities, telecoms, consumer staples. All the risk-off sectors are doing very well. Utilities are near all-time highs. Telecoms, they're all-time highs. In search of yield, we've got such low interest rates, and I've been saying this for quite some time. I noticed some of the talking heads on TV are just now picking it up. But the bond market is just really, really just decimated. So why don't we just go through and take a look at the charts and what we're seeing here. I got a lot on my screen here, but let me just simplify it real quick for you just to show you. And if I just box in this tumultuous time right here, you can see that time frame that I discussed, right? Just like that. I mean, we have basically seen 2134 and 1800. So inside this range here, right? Inside that range of about 334 points. We've been up and down, and we visited the downside several times. We visited the upside several times. Normally, in less than about a year's time, we tend to stay more towards a top quartile, or up in this area here, or a bottom quartile down here. But here, we've visited both many times, from down here several times, and then up here several times, right? And then we've come down and we've tested the center of this range over the past year several times. So it has been a very difficult year for folks that are looking to pick stocks. If you were on the right side of the markets, meaning you were just glued to utilities only, or telecom only, or some of the staples, you've done fairly well. Or you were in bonds. The bond market, just to give you an idea, has returned over 16.9, almost 17% for the year. The 10-year Treasury note has returned about 8% for the year. All right, and the dividends, if you include dividends in the S&P 500, the return for the S&P is about 3.84%. So money is coming into the equity market in search of yield, okay? So remember that. With these low interest rates, that's kind of the environment that we're in right now. And this can turn on a dime, as you guys can see. If we look at this big up move that we had this past week, the nice thing about it, it was accompanied by higher volume. You can see the big move down caused that huge spike in volume. And just all that money just got taken out of the market. And then the very next day we had a follow-through day. But then from there, we just shot right back up, and we're almost where we started before the vote Thursday evening. And you can see, though, the volume here, and I use a 5 and a 20 EMA, overlaid my volume just so that I know that if the 5 is over the 20, just like you follow charts, right? And everybody uses different EMAs, but down here for volume, this works very well. When the 5 is over the 20 EMA, then over a near-term basis, 1 week over a month, we're getting higher than normal volume. And that's what we got right here. So that does tend to suggest that the money that just as quickly went out came back in. Now, granted, some of this was short covering because the markets were getting fairly short leading up to this vote here. Right after the vote, a lot of shorts came in. The volatility was very high. We'll take a look at that in a minute. But you can see now off of that low here where we're sitting on this daily chart. Okay, now if I put in all my indicators, let's just put them all in here. I'll get a little bit busy on the chart, but you can see here, if I zoom in, let's just zoom in so that you can kind of get a better better focus on this thing right here. You can see right here, we're coming back up now to what I call the Death Valley area, which is right in this area here. I could extend that back over to 2015 because our all-time highs are at 2134. This is the E-mini S&P 500 futures, of course. But you can see there is a lot of overhead resistance up in this area here. And we've hit this many times, and we just cannot seem to get above it. Okay, so I do believe the upside here is going to be limited until more details are sorted out with this Brexit vote and what it means. I'm already starting to see rumors come across the transom that says, well, they're going to delay invoking their Article 50 that formally says we're going to leave. They may invoke that for several years, and I even hear other rumors saying they may Parliament obviously has to vote to approve the Brexit. They may turn it down and they may stay in. I mean, there's a lot of rumors out there. And guys, as you know, you cannot follow the rumors. As for those of you that thought the British were going to stay, you were all surprised, right? So you can't do that. You got to follow price action. And if we look at this price action, we're probably going to come back up. Momentum may carry us back up into this area here, and then we're going to run into a soft spot. I do believe, though, if things calm down, we're going to challenge the 2134. We may even go a little bit higher. But I think the risk of a bigger move is still to the downside instead of the upside. Okay, because these markets can turn on a dime. Because if we come back, I will show you right over here back on back in August when we had that big move here in August. You can see right here, once the Chinese devalued the yuan, we came all the way down here and we rallied hard up here. That was over about a 180-point rally to the upside. And then we came down and we came back up. We actually broke a key area here, key pivot area, but then we gave it all back up and we gave up almost 180 points coming back down before we got our bearings and started moving higher again. Okay, so the move that we're experiencing now, while is really good, we need to be able to see that the prices can hold. On a daily chart, it's really very simple, guys. If I take all my indicators off the screen again, we really got a couple of key pivots that we're going to be looking at. That's that pivot low right there. Here is the pivot high right there. That's where we're sitting. And we want to be able to hold these. So 2119 and 1981. We will break one of these. I believe the near term will probably break 2119 and challenge the 2134 area, which is the all-time highs of the S&P. Notice we've completed a Elliott wave cycle here on this daily chart. We had this 3, 4, and 5 move. Now I had forecasted the 5 move would actually challenge the 2134 area. I was a bit short in that, but we were going in the right direction. And then obviously we got this huge ABC pattern. And typically after a 3, 4, 5 pattern, you do get an ABC pattern. And the key with ABC patterns is where are their pivot highs and pivot lows with each of the A, B, and C legs. So we've got a B leg and a C leg pivot, as I've indicated right here. And then we've got an interim pivot on this A leg that is sitting right in that area there, 2040. So 2040, we want to hold up near term going into early next week. We may see a little bit momentum coming in. It's going to be a long weekend that we're facing. It'll give the markets time to settle down a little bit more. Keep in mind, with the strong sectors, utilities and telecoms and consumer staples, they're all risk off. I don't like to see markets making all-time highs when you got risk-off sectors leading the way. That's a non-traditional correlation. Usually when markets are making all-time highs, you've got the risk-on sectors, and you've got small cap, you've got technology, you've got some of the others leading the way, consumer cyclicals leading the way when you're hitting all-time highs. But those guys are lagging. And that concerns me a little bit. And the primary reason why we got that, as I said, is interest rates are at all-time lows. Okay, we got back above the zero line again this week. We were in the red. The S&P was in the red for the week, and then we got back above the zero line again. You can see this blue line right here is the opening price of the S&P 500 E-mini futures, 2037.75 for the year. We blew back through that on the 29th. Which was Wednesday, and then we just kept the momentum going, and now you can see this wider shaded zone here in 2103. We've got a little bit of a resistance spot here that we're probably going to hit, but it's going to be real interesting to see. I think the markets will consolidate some of this big, huge move we had this previous week. So we'll see. We were not going to see that kind of move this week. Or, I mean, you know, you never say you're not going to see it, but the odds favor that not happening. The odds favor a little bit of a slackening in the upward momentum here. Again, I think the first couple of days here was short covering rallies, a little bit of a short squeeze, and then we had some volume kind of come back into the markets here. We also came back up over the 50 EMA and the 200 EMA, as you can see here. So, you know, we kind of set ourselves up here rather nicely, okay? And we've got this pattern. But overall, if we step out for, and we look at a weekly chart, we really, if you think about it, guys, and let me just take everything off the screen again, except for my long-term fibs, we're really just in about a 300-point range. And it goes back really here to in this area right here. Okay, so since about the beginning of 2014 through halfway through 2016, we've been in this very wide range here, and we just cannot seem to penetrate. We made these highs around May 20th of 2015 at 2134, and then buyers come in at this point here. You can see this volume over price right here. We got that big spike right here, and if I were to extend it over here like that, you can see right there, that's where a lot of volume is sitting. A lot of in this case, potential sellers and overhead volume is sitting. Now, if we can get up above it, we may have a nice little run up a little bit higher before another pullback. But there's a lot of volume sitting right at that area there. Okay, so we've been in this wide range, and it is a difficult market to be a player where you're going to buy stock and own it for 3 or 4 months, because generally you will see yourself in profits and in losses at the same time over that 3 or 4 month period of time. For options traders, it's been a great time for volatility. We've had some really interesting plays from a volatility perspective where we've been selling the premium when it's high and buying premium when it's low. So it's been a nice time, but clearly since the March 9th lows and we've moved up here, we've hit this stone wall. And I think until we get some more clarity out of the central banks, they've driven these markets. I think they've driven the S&P 500 a lot higher than normal with these low interest rates. And again, we've got, just to say it for the third time, we've got utilities, telecoms, consumer staples leading the way. And that's not right when you're near all-time highs, all right? So there's still a caution is the watchword here for the markets. But just what a really interesting week we had here, okay? Now, if we come out and we take a look at the bond market, which is what I want to show you here, this is just totally amazing to me. The bonds finished up 2 points. We're at all-time highs here in bonds, 175 and 11 ticks. It's just truly amazing to me. I mean, the bond market to get this high, and I've said this over and over, it's not U.S. investors doing this right now. All of this money right here that is coming into the bond market, right? And it's just coming in, it's just pumping in like crazy. It's coming in from Europe and it's coming in from Japan. Right now, globally, over 37% of all global debt is below 0% interest rates. I think there's like $12 trillion in debt globally that offers less than 0% interest rates. So what do these investors do? Big money. That, you know, if you've got a couple of $1 billion and you want to park it for 6 months, do you want to park it somewhere where you got to pay the fee? You know, you got a nice car and you're driving down the road, and on one side of the road it says free parking, and on the other side of the road it says you got to pay to park. Well, where do you think you're going to park? You're going to go to the free parking zone. In a way, this is like that. All the money is just, it's not going into so much some of these spots over in Europe and Japan. It's coming into the U.S. bond market, right? Or the U.S. Treasury market on the shorter end of the yield curve, because we're paying, you know, double and triple and 4 times the interest rates that they're paying in Europe and Japan. And not only that, but we've got the U.S. bond, the U.S. government behind it, which is supposedly the only risk-free investment out there, 10-year treasuries and 30-year bonds, right? Supposedly risk-free. Yet you've got that huge dichotomy between Europe and Japan and the U.S. bond market. So that's where the money's coming. And I know a lot of professional trader friends of mine and guys that are running hedge funds have been trying to jump in front of this train and short bonds, and it's very difficult to do. In fact, we took a little bit of a short position in the bond market, and we got stopped out for small losses because you're just standing in front of this train. Now, I will say that the bond market will come back down again, but it will not start that steady decline down, and where you will see steady interest rates going back up until we see some stability in the European and Japanese debt market. Otherwise, that money's just going to stay parked here, and you'll see demand for U.S. debt a lot stronger than demand for other debt, where you got to pay to get that debt. And that's what's caused this issue here. If we look at the 10-year Treasury yield right here, we are down at my target now, and then I've got a longer term target down at 1.14. My short term target was 1.45. We're sitting right now right at about 1.45. 1.46 was my target. My longer term target for 10-year is 1.14, which suggests it could go even lower. Remember, as Europe and the ECB starts their bond buying program, even corporate bonds, is going to drive their rates lower. So we may see even more negative yielding debt, which will drive more money to our 10-year and 30-year. And if you look at, so you can see just how low the rates are. And if I go out to a weekly chart here on the 10-year interest rates, right? You can see here we're almost down to the lows made back in 2012, the summer of 2012. In fact, July 23rd, 2012 were the lows in the 10-year Treasury. And we're almost there right now. And my system is saying that we can go even lower. And if you look at this, I don't see anything stopping this right now based on the dynamics of the market. And if we look at the 30-year, right, if we go into the 30-year, or let's go into the 30-year interest rates, that would probably be a little bit better. So if we go into the 30-year, look at this one. We're right down at my target now on the 30-year here. And this is a weekly target. So let me just get this up here a little bit so you guys can see it. You can see right here, we've hit it twice. We've done I don't believe the 30-year is going to go much lower than this. My target, my long-term target was 2.16. We're at 2.24 now. Okay, and I know when I initially drew this target up, we were way up in this area here, around 3.5% interest back in back over in late 2013, early 2014. I just said there's no way we're going to go down there, and sure enough, here's where we are. But that was the target. So that means that over the next 3 years, I think a longer term play will be a gradual rise in the interest rates, meaning TBT to the long side, TLT to the downside, bonds to the downside, treasuries or bonds to the downside, treasury notes to the downside, interest rates to the upside. But it's going to be a long haul, and it's going to be only for those investors that will be willing to take some losses in the interim, because we can't have them. Although I believe the risk now of a bigger move is going to be more to the upside than to the downside. We're starting to see that shift, but at least near term, we still have more of that to go. But I can tell you that once Europe and Japan start to settle in with their debt and their economies start to show hints of inflation, and their debt starts rising above zero, you're going to see money get sucked out of the U.S. bond market, debt market really quickly. And if we look at utilities here, which is, or the utility sector, which trades this way, look at the sector here. We're at all-time highs because it trades like a bond. And I do believe that this is going to be a great short opportunity. And for our members, we do not want to front run it because remember, when utilities was coming down here, we've got this nice 3, 4, 5 pattern as it sets up right now. Not a lot of divergence in it. If I look at the oscillator, you can see even in the oscillator, I'm getting absolutely no divergence in this 3, 4, 5 pattern. And typically on an Elliott Wave 5, it concludes the series or the run, looking for a change in trend possibly. In this case, I believe that it's going to stay a lot higher longer than people think. But I do believe selling calls above here, keeping your spreads relatively tight, your risk small, could be some really interesting play here. I think it can run a little bit higher, but I think we're coming towards the end of that. And also, if we look at the volatility market, now, for those of you that are members, you know what this chart is going to mean. If you're not a member and you watch our weekend updates, hopefully you're getting a picture of it. I divide my VIX chart into zones because it's very helpful here. Let me just take it out to a daily. We'll just zoom in a little bit here. I keep them in zones. These zones represent different trading strategies for option players. Zone 1, 2, 3, 4, and then zone 5, which is a black swan event. And then I've got in parentheses percent of capital deployed, and it's not exact, but it's kind of a rule of thumb. Plus or minus 5% or so. So for example, if you're down in zone 1 and you like to sell credit spreads, you do not, especially in the SPX, you do not want to be deploying more than 25% of your capital in credit spreads because you're selling premium when it's cheap, and volatility will mean revert a little bit more expensive, and you get these pops and you get underwater very quick. As you move from zone 1 to 2 to 3 to 4, premium gets more expensive, more rich rather is a better word. You can then start deploying more capital as option selling, especially in, and it works the same with equities too, much like coming up to a binary event like an earnings, which by the way, we have earnings coming up here starting in another couple of weeks, and we're going to get a good picture of U.S. corporate earnings. That's going to be the next event that's going to drive the equity markets either through 2134 or back down again, because we're going to determine just what the Brexit vote did and the stronger dollar is going to do for the remaining 6 months of the year in the earnings. So pay attention for the earnings that are starting in a couple of weeks. Pay attention to the forward guidance. But if you do look at volatility here, let's just stretch it up a little bit so that you can see a little bit better. You can see we moved from zone 3 all the way back down, and we're at the top of zone 1 right now. We're still kind of in that area where I would consider it zone 1 instead of zone 2. While we're up in this area here, I was encouraging our members to take a look at some put premium collection strategy here by selling some of the volatility because it was a lot higher. And we've seen this fall in volatility. So that is that. And then if we look at the VVIX, which is the volatility of volatility, you can see right here it's one of the few times that the volatility of volatility got so high. This was before the Brexit vote. And even though the VIX was really low or relatively low, the volatility on the VIX was very high, which suggests that people were starting to load up on VIX calls, out of the money calls, and we were trading out of the money VXX calls, and we were making 4 to 10 times our money on those trades. It was really great. And then of course when they left, you can see what happened with the VVIX. It came back down once volatility kind of settled back down again, and the unvolatility dropped. So and I haven't seen it this high very long. And we also had the skew index, which was also very high as well, which essentially measures the skew of a typical standard deviation move. But you can see here, if I go way out in time here on this thing, just how often or lack thereof the VVIX has gotten up into this rarefied air. Only just a few times, going back about 3 years, have we seen it happen like this. And of course, up here was the implosion of the markets with when the Chinese devalued the yuan. And by the way, over this past year, you know, I boxed in the year for the S&P. Over this past year, twice we've seen the E-mini S&P 500 futures go lock limit down. Twice in 1 year. Unbelievable. And it takes about a 5% move to the downside to actually stop and halt trading for a little bit before 8:30 in the morning. And then once you get after 8:30 in the morning New York City time, then that lock limit expands to 7%. But we've seen this happen twice now in 1 year. I believe, folks, with all the black box trading out there, with the computerized trading, and with the sophistication of markets now, particularly the global aspects of markets where something happens in China, it reverberates over to Europe, and then it swings its way over to the U.S. markets very quickly. 10, 15 years ago, you didn't really have to worry about that. You just worried about what was going on in your own backyard or here in the U.S. Now you got to worry about all of this. That's also created money flow from country to country, asset class to asset class. And that's what's caused these big reverberations in the market. I think that's here to stay, at least for the next 2 or 3 years, as the markets sort out all this global stimulus that's slushing around, and the banks are taking it in the shorts. The banks are one of the worst performers right now because they make their money on net interest margin, and it's just not happening right now for the banks. Their cost to borrow and their cost to lend, that difference between the two is very, very low. If we look at the currencies, you can see what happened to the British pound. It totally came down and made these new lows, and we're sitting down here. Now, if they raise interest rates, and by the way, we were playing the pound to the downside late Thursday night, Friday morning. We just rode that sucker all the way down. It was a fun trade. And you can see that I think the British pound could possibly go even lower. Some people are calling it to go parity with the euro. But the euro is going to have its issues too, because one of the big issues with the Brexit vote is it'll encourage other countries to say we want to do it also. So there's still some of that potential fear in the market. But understand the definition here, or not the definition, but the cause of fear. This is political as opposed to financial. 2007, 2008 was a financial event. And those tend to last a lot longer because it takes a long time for the markets to work their way out of the hole in a financial catastrophe. In a political catastrophe, like we've got with the Brexit vote, sometimes you get this rebound like you get here very quickly. But this political can turn financial, which is where the markets are concerned, if other countries want to get out, and it starts to create turmoil, which forces other central banks to loosen their policy standards even more, put even more money out in the market, and drive their already negative interest rates even lower, which then pumps more money into the U.S. markets and drives our bond prices higher and our yields even lower. So we don't need to forecast that. Those are things that are on the horizon, but what we'll do is we'll pay attention, as we always do, to our key pivot highs and key pivot lows and watch them very closely. If we look at gold, gold has really had a very interesting week. Gold at first was selling off going into the Brexit vote, and then it just shot straight up. Gold was one of the assets I said you want to go long if they decide to leave. And sure enough, that's where we've gone, and we're coming back to 2016 highs of 1362. We've got this 3-4-5 pattern, which does suggest to go much higher. It's going to be very choppy here. If you missed most of this move off of these lows down here back in early January, because gold's been a great performer for the year. In fact, all commodities have been. You can see the opening price of gold for the year was right around the 10,000 range with this blue line right here. 1061 was the opening price of gold for the year. So gold has really moved nicely since we've come off of the 2016, and we're approaching 2016 highs. Silver is another one. Now with silver, I've told you guys, it's moved very nicely. You can see, look at what silver did on Friday here. Really strong to the upside. Now, I was accumulating silver down here around the 13 level. This is the silver futures. If we look at SLV, SLV moved huge to the upside on Friday. Look at this move, this big gap up here. Really big move. We were accumulating SLV down here around 1350, and I believe I was on record here saying that I believe silver is going to get up into the low 20s in the next 2 years. And now I started talking about that in the Q4 of 2015. So, we're still on track going in the direction that I believe we're going to head. And we had this huge gap up here with silver. So I think that one could work out nicely. Oil, I think, also had a strong day on Friday, but I think the upside of oil will be a little bit limited, at least for the remainder of 2016. You can see when oil comes down and hits its 50 EMA, the 50 EMA has been a bounce point, but we are on an extended 3, 4, 5 pattern right in this area here. I don't believe that. I believe this is probably more realistically. I would override the count and make that a 3 leg right there, and I would this would be a minor 3, a small 3, and a small 4, right? An Elliott wave within an Elliott wave, essentially. But we are getting some of that bearish divergence here. So what that would suggest to me that any upside here, we're going to be looking at selling calls, because I think we're going to probably stay in this range for a while and consolidate in the oil market. We've had some great trades in oil, gold, and in the agricultural market. In the ag market, we've had 5 winners in a row in soybeans. You can see soybeans here had a good crop report, unlike corn, but you don't see corn, soybeans, and wheat move too far away from each other until they start to self-correct again. So we're going to be looking at putting on another trade in soybeans here as well. Now, there's a lot of other stocks and equities that we've been looking at and we've been playing around with. But for now, I just wanted to point this out. If you're not a member of our group, I think we've got a 4th of July special. Even though you're not in the U.S., you can take advantage of it. It's a really low-cost way to just come in and check us out for a month. Get a free one-on-one session with me for about 30 minutes to assess your trading. I've worked with a ton of people, hundreds and hundreds, thousands, or over almost 1,000 people I've worked with individually. And I can sit with you for about 30 minutes, and I'll give you a pretty good assessment of where you are as a trader. It'll require you to fill out a short survey, which only I will see, and then I'll go through it with you, and then I'll give you half off for the month, and then you can just have everything that we do for the month. And then at the end of that, you can see what you want to do. We have a lot of folks that do that and come in and sign up. For those of you that are watching my weekly free updates on the weekend, we're pretty darn close as where the markets are going. We've been pretty good at making these calls. I see 2016, the remainder of the year, being not that much different than the first part. There's going to be some grinding higher moves and then some sudden shocks to the system. I am still on record as saying that before the end of 2017, we will get a 20% pullback. I don't know what is going to be the trigger. It could be a number of things, as I pointed out earlier in this session, but I do believe we're going to get that pullback. And it may be fairly ugly. It probably will be greater than 20%, and we'll be ready for it when it happens. There'll be some great trades to take, especially in some of these asset-rich bubbles that we're creating here. All right, everybody, for those in the U.S. markets, have a great 4th of July weekend. For everybody else, I will see you. We will be back active again in our group. We're not going to do a Sunday night session, but we will be back active again Tuesday morning for our pre-market session. We'll take a look at where the market's going to be opening and what the key levels look for the week based on the futures, overnight futures action Monday night into Tuesday morning. All right, everybody, have a good weekend. Ciao.